China's revenge unleashed. $17.2 billion meltdown sends shockwaves through global markets. Investors are absolutely panicked right now because the nightmare scenario that we have been warning about for months has just begun. China has finally unleashed their revenge on the world, and this is going to destroy a lot of portfolios. What we're seeing now is an absolute meltdown in the markets. In today's video, we'll be taking a look at how the entire world is being affected by what's happening in China right now. We will also see which sectors are being hit the hardest. So if you want to find out how this affects you, then make sure to watch this video until the very end. And of course, smash up that like button because it helps out tremendously. As you can see, all eyes are on China right now. The world is watching anxiously as the country's property market continues its free fall. Now recently, the government tried to intervene and help stabilize the situation. But unfortunately, this did not work. And things have gone from bad to worse. Now investors are starting to get really scared because they know that the Chinese property sector is too big to fail. And the longer this goes on, the more likely it is that other industries will be dragged down with it. Evergrande was downgraded to restricted default by Fitch Ratings yesterday after failing to pay $47 million in interest payments. This is a very important moment because it marks the first time that a Lansky Chinese property developer has defaulted on its international debt obligations. This sends a huge warning signal that other Chinese developers may follow suit, and this could lead to a chain reaction that weakens China's financial system. To make matters worse, another major Chinese developer just defaulted on its debts last Friday. Now, Casa Group failed to make a bond interest payment of $146 million before the end of a grace period. Analysts are predicting that we could see as many as $36 billion in offshore defaults by Chinese property developers over the next 12 months. And this includes another $6 billion worth of repayments that are due within the next month. The problem is, China does not have enough foreign currency reserves to cover all these debts. And the only way they can do this is by printing more money. But this would cause the yuan to lose even more value against the US dollar and accelerate inflation. This is a catch-22 situation, and the government is between a rock and a hard place. There's no easy solution to fix this crisis. What's even scarier is that this may just be the beginning of China's economic collapse. The Chinese economy is highly dependent on exports and manufacturing. If there's any disruption to this sector, it can send shockwaves throughout the entire country. And this is where things start to affect us here in the West. Just take a look at this article published by the Financial Times. It talks about how the debt crisis in China's property sector spreading to its vast network of suppliers and contractors. The article gives us some real insight into what's really happening behind the scenes. Many smaller companies are now struggling to get paid by developers who are sitting on a mountain of debt and have little cash flow to distribute. This is seriously affecting their ability to fund day-to-day operations and stay afloat. Many of these businesses are now having to scale back production, and some may even go bankrupt if things do turn around quickly. The knock-on effect of all this is that people who buy products made by these companies will have to pay higher prices, or worse, won't be able to get the products at all. This is the real danger of China's economic collapse. It will impact every single one of us, no matter where we live. So this is the true extent of the crisis that we are facing right now. But before we get into that, let's talk about something you might have heard about recently. In the last few months, we have seen several central banks around the world start to raise interest rates to curb inflation. Now there's this common misconception out there that says once interest rates start going up, then stock prices will come down. However, this is not always the case. After all, interest rate hikes are supposed to be good news for the economy. They are meant to encourage people to save more money and invest in productive activities rather than just blowing it on stuff they don't need. However, when interest rates rise too quickly or too far, it can throw the economy off balance and cause chaos in the markets. This is exactly what happened back in 1979 when Paul Volcker raised interest rates to nearly 20%. Back then, the stock market plummeted by 44%, and it took 25 years for the S&P 500 to reach new highs again. Of course, this is not financial advice. Any decisions you make should be based on your own research and risk tolerance. Now, let's get back to the video. Like I mentioned earlier, China's debt crisis is just getting started. Let's take a look at this report from Bloomberg, which shows that the property sector accounts for almost half of China's total borrowing. Over the past decade, local governments and state-owned enterprises have borrowed heavily to build infrastructure projects in anticipation of future growth. But now that growth has slowed dramatically, these borrowers are finding it difficult to repay their loans. Analysts estimate that there could be a wave of defaults among Chinese borrowers over the next year, which will likely have a ripple effect throughout the global economy. Investors are becoming increasingly worried about the stability of China, its financial system, and are demanding higher yields on their investments to compensate for the added risk. This is causing borrowing costs to skyrocket, which is making it even more difficult for businesses to repay their existing debts. As things stand right now, China is caught in a vicious cycle of debt and default that could easily spiral out of control. And this is why everyone is calling this China's Minsky moment. Hyman Minsky was an economist who developed a theory about financial instability. He argued that periods of economic growth often start with a boom in borrowing and speculation, but eventually come crashing down when those with the riskiest debt end up defaulting. This triggers a chain reaction that weakens the financial system and causes a recession. The question is, what happens if this Minsky moment hits the world's second largest economy? Well, the consequences would be devastating, to say the least. As you can see, the whole world is deeply interconnected. When the Chinese economy sneezes, the rest of the world catches a cold. For example, many U.S. companies rely on cheap manufactured goods from China to stay competitive. If Chinese exports become more expensive or harder to obtain, it will drive up the cost of American goods and services. This will put upward pressure on prices and contribute to inflation. On top of that, the United States imports a significant amount of products from China, including medical equipment, computers, and machinery. A disruption in the supply chain would mean fewer products available in American stores and higher prices for consumers. This could have a serious impact on our economy and lead to stagflation, where prices keep rising while the economy stagnates. China is the biggest trading partner of many countries, including Canada, South Korea, and Germany. If the Chinese economy collapses, it would devastate these countries and cause them to fall into a deep recession. For instance, Canada exports a lot of commodities to China, such as oil, natural gas, and agricultural products. South Korea relies on China for a significant portion of its exports, including cars and electronics. And Germany depends on China for a variety of manufactured goods. Slowdown in Chinese demand would have a disastrous impact on these economies and lead to job losses and decreased economic output. This could also cause other countries to default on their debts, since many emerging markets have borrowed heavily from China in recent years. Some estimates suggest that as much as $2 trillion worth of loans could go bad if China defaults, which would trigger a wave of sovereign defaults throughout the developing world. A Chinese collapse would have a serious impact on the global financial system. For example, many international banks have exposure to Chinese debt, which means they could suffer huge losses if China were to default. This would undermine confidence in the global financial system and could lead to a credit crunch where banks are reluctant to lend money. On top of that, global investors hold trillions of dollars worth of Chinese assets, including stocks, bonds, and real estate. If China were to default on its debt, it would cause a sell-off in these assets, which would lead to even more pain for investors and further destabilize the financial system. We are already starting to see the effects of China's economic slowdown on the global markets. Take a look at the Nasdaq chart. You can clearly see that the index has been falling in tandem with China's economic data. As China slows down, so does the US markets. This is because investors are starting to price in the possibility of a Chinese collapse and the negative consequences that would have for the global economy. The same thing is happening in Europe, where the Pan-European Stocks 600 index is also down significantly. And this is mainly because of exposure to Chinese markets. Now, many European companies rely on exports to China to drive their growth, so a slowdown in the Chinese economy will have a direct impact on their bottom line. Now the effects of China's debt crisis are going to be felt across all asset classes. For example, gold and silver, which are typically seen as safe haven assets during times of economic uncertainty, have been under pressure lately. This is because investors are still hopeful that the Chinese government will be able to stabilize the economy and prevent a full-blown financial crisis. If that happens, then gold and silver prices will likely fall. On the other hand, if things continue to go south and the Chinese economy starts to collapse, then these metals could soar in value as investors scramble for safe haven assets. Similarly, cryptocurrencies have also been suffering from China's economic woes. Recently, the country announced plans to crack down on cryptocurrency mining and trading, which has led to a sharp decline in prices. Bitcoin and Ethereum have both lost more than half of their value since the beginning of the year, and analysts predict that this trend will continue if the Chinese economy continues to weaken. The best performing asset class so far has been the US dollar. As the world's reserve currency, the dollar tends to strengthen during times of global economic uncertainty. That's because investors often flock to safe haven assets, and the dollar is seen as one of the safest investments around. On top of that, the Federal Reserve has signaled its intention to raise interest rates in the near future, which makes the dollar more attractive to investors looking for a higher yield. As you can see, China's debt crisis is a ticking time bomb that could blow up at any moment. The longer the government delays addressing the issue, the worse the situation will become. And this could have serious implications for the global economy. Now, this is not financial advice, and these are just predictions based on the current situation in China. Only time will tell what actually happens, but one thing is for sure: the coming weeks and months will be very turbulent for the markets. So make sure to stay tuned for more updates. Don't forget to smash up that like button because it helps out tremendously. Thanks for watching, and until next time.